Welcome to our market update video. We're Dynamic Wealth Management. I'm Grant. This is Gary. Adam is our third partner. Today is the 21st of December 2018, and a lot has happened since our last video. So we're moved into the yellow zone since then, and today we're going to show you in our video that we've moved even a little farther down into our red zone. So we'll walk you through everything that's happened and some of the reasons behind why we're doing what we're doing.
That's exactly right. So we've been in our yellow zone for about 4 weeks now, which has really served us well as the market's bounced around in a zone of about 6% up and down. But we finally broken into our red zone, and today we got fully defensive.
We'll jump in the charts and show you what we're talking about.
Good to be with you folks. Again, we're Dynamic Wealth Management, and this is our update video for December 21st, 2019. Today is Friday. And let's walk you through, first of all, what we have coming up as far as events. A reminder that we do investments for breakfast every couple weeks here in the office. The next time we'll do that after the holidays is at 9 a.m. Tuesday on January 8th. And that will be done in our conference room. And it's where we present a lot of the information that we talk about in this video, along with a bunch of other information. And it's very open forum. We're not selling anything. The whole idea is to educate and give you as much information on what we see on the stock market, the economy, interest rates, and strategy for protecting and growing your money. So as we indicated in our opening of our video, we are now into our red zone, as we call it. We have pierced through price action that was key for us, and we had already outlined and indicated that was a key support level. That was broken over this past week, and so now that has pushed us into our red zone, and we did make allocations to get more conservative, and in fact we are completely out of equities at this point as we enter the red zone. So we'll talk about more of what that means, why we got there, how we got there, where we might be going from here. The big news this past week, I believe, came out on Wednesday, which was December the 20th. And as you can see, this was a snippet from an article in MarketWatch. And we also pulled this meme from the internet. This is Mr. Powell, who is the current Fed chairman. And as you can see behind him, the movement of interest rates. And so on this day, the Fed came out and said, you know what, we're going to raise short-term interest rates another 1/4 point. Not only that, our plan is to raise short-term rates probably 2 more times into 2019. And that news, along with the potential for a government shutdown, which may be imminent here in the next day or so, did shake the markets. And in fact, on this day alone, the Dow was down more than 450 points. And that selling continued. Not only the next day, Thursday, but also today, Friday, the market continued to push downwards and pushed us into what we call our red zone. In fact, let's take a look at that as we look at some market charts. Probably one of the key charts that everybody's trying to wants to look at. This is the S&P 500 on a daily basis. Every one of these marks, which we call candlesticks, represents 1 day in time. This chart is looking back over the last 3 years. What you can see here is beginning in 2016, the market has had a great run. In fact, very low volatility as it pushed higher and higher into new highs. We got into January of 2018, and finally the market did give up about 11-12%, but it did bounce back. It settled down, and we climbed again throughout the year, only to hit the all-time high at 2940 the end of September, beginning of October. And finally, the market did drop. In fact, it was a substantial drop in October. And then recently, price action into November, December has gotten much worse. You can see here by this line, this is where we pushed through our yellow zone. Notice the market did bounce back after that, but only to continue to go down. In fact, what we noticed in this period of time is on the bounce backs, they didn't go up as high. So you have lower highs and you have definitely lower lows. So that is the very definition of a downturn. You also had some key long-term moving averages like the 200 that were pierced and broken. You have the 50 crossing the 200. All of these things are things that we watch and help us to make our decisions as to where best to fit our clients' money, where volatility and risk are taking place. And so here you can also see we put a red line there. This is where we broke through our red zone, and we are now fully defensive, meaning that we're fully out of equities and commodities and any other growthy type assets and into more conservative short-term bond and income type investments. So we'll sit the market out, let the market settle down. We're probably due for a bounce back, but right now we want to respect price action as it has substantially broken through into the red zone. Let's take a step back and look at it on a weekly basis. This is the market action over the last 5 years. Every one of those lines or ticks represents a week in time. You can see here where the trend has really changed, and we're really on a downward trend as far as price action. Again, we don't know how long that's going to last, but that's a substantial move. And of course, this past week we broke through the bottom of that. So we're due for a bounce back, but it certainly looks like we're running out of time at the end of the year to get that Santa Claus rally that everybody was expecting. Now the big question is, so let's look at the next chart. So this is a monthly chart over the last 25 years. Now every one of these marks represents a month in time. So you can see the last two of the last 3 months have not been good at all. Big long red months there. And so does this turn into this or this? That's the big concern, right? That's what everybody is watching. And or is this more like this and this, where the market finally settled down and then we went on another bull run again, right? Well, there's a couple of things or a few things we would like to point out that do concern us right here as we are trying to figure that out. But for now, remember, our price action is king. And instead of trying to predict whether this is really a long drawn out bear market or the next recession, we don't predict. We respect price action. And price action right now is telling us you need to take some action, and it does not look good. Now, and then we'll let the market dictate to us if it continues to roll down or if it settles down like here, and then we go on another bull leg. One of the things that's different for us here is we are definitely in the latter stages of this bull market. Could we go on another leg up? We could, but there's been a lot of technical damage other than the S&P 500 that we'll point out here in the next few slides. So with that, I'll go ahead and turn over the next few slides to Grant, and he can finish out the update for us.
Okay, let's jump back into it and let's look at the asset classes here. So here's the overall S&P 500, and if you'll notice, the Dow's right in line with it. The NASDAQ or the tech stocks is down, not quite as bad. Small caps is down worse, but here's the important thing to note: emerging and international developed markets down 15 and 16%. So United States, even with this big drop, is holding up much better than the rest of the world, as we'll point out in more detail in the future slides here. But the U.S. holding up much better. And that is one of the key reasons that we haven't held any international positions in the models that we manage here over the last few years, is because the U.S. has consistently outperformed international, and that's benefited our accounts. All right, next slide. So here are the sectors of the S&P 500. So let's see what's doing good and what's doing bad. You'll notice the big losers are industrials, materials, and energy. You'll notice the things that are really holding up well: healthcare and utilities. The key to point out here is that it's really a risk-off scenario. These are two very defensive sectors, and so when you see the really defensive sectors doing well, that does give you some pause. It starts to paint a picture, give you some evidence of where the market might be headed. All right, so here is, I told you I'd give you more details on all the countries in the world. So this is kind of a busy chart, but you see the United States is here. They're the red line on top of everything here. Note the steep decline at the end. But you'll notice the rest of the world, when we were still in positive territory, the rest of the world was already down 12, 13, 14, 15%. Actually, now, if you look at it, Germany is down 22% now. So that's just within this 1 year. So, and a big, strong country in Germany to suffer like that. So everyone was thinking that we would follow suit and eventually kind of get in line with the other countries, and that's what's happening now. This is about the yield curve. You'll notice that the last couple times the 10-year Treasury yield curve changed. That happened right before the 2000 drop, which was a 48% drop. And the yield curve also inverted right before the 2007 and 2008 big drop. And if you'll notice, we are very close to having it happen now. I think we're about 12 basis points away. So that's another thing that shows us, okay, maybe it's time to get defensive here, right? Here's another really interesting one. You'll notice that the yields on all of the different treasuries tend to bunch up right before a bear market. They bunched up here. Again, this was the 2000 drop. They bunched up here right before the 2008 drop. And if you'll notice, they're getting pretty close here again. So again, our job is not to guess or try to estimate what the market's going to do. Our job is to collect evidence and to take signals based on real data. And these are some things that led us to get into the red zone. Now, here is something that we are expecting. So if you'll notice, this is called the McClellan oscillator. It's an indicator that we look at that helps us to know when the market is overbought or oversold. When it's overbought, you'd expect it in a short-term basis to decline. When it's oversold, you would expect it to kind of pop back up. So obviously, with how bad the market has crashed recently, this indicator is telling us that we're probably due for a little bit of a pop. But if you'll notice, we've consistently had these lower lows, and even though it does bounce back up, it goes back down and bounces back up and goes back down. So in the short term, we are expecting a little bit of a bounce back here, but we still obviously feel that the overall trend is proving us to be a negative trend right now. That being said, let's jump into our model allocations and show you what that means. So obviously we closed beneath this bottom red line this week, and that is the key. That's what moved us down into the red zone. What does the red zone mean? The red zone means that each of our clients that are in our core ETF model, whether you're a growth client, a moderate client, or a conservative client, all of our clients are 100% defensive at this spot. So that's key for us. Obviously, if the market really falls apart here, that would be great. If the market fell 50% and we were able to buy back in much cheaper and have got out near the top, that would be fantastic. If the market does the opposite, stops here, turns, and goes straight back up, which is a real possibility, if that happens, then obviously we'll cross back over our lines and we'll get back in. The key for us is to act early, not late. We want to be the first ones to take action to protect our clients and make sure that we're on the right side of things. Thank you so much for watching this video. Please reach out to us with any questions or concerns that you have, and we'll look forward to talking to you soon.